All right, welcome everyone to today's webinar, Charitable Gifting, presented by John G. Ullman and Associates, Inc. Many thanks to our presenter, Todd Brost, for being with us today, and to all the participants who have joined in, and to our educational series sponsor, Chemung Canal Trust Company. Please note this webinar is being recorded to share what we learn with the business community. All attendees will receive the link to the recording. Todd will share the presentation with you and then follow with time for questions and discussion. Please use the chat to submit any questions during the presentation. Just a reminder, when others are speaking, please keep your audio on mute to minimize background noise. With that said, I'll turn it over to Todd to start things off.
Great. Thank you, Beth, and thank you to Chemung Canal for hosting this. Also, thanks to the folks on our end in terms of Dave and Ryan and Rebecca. I got the easy part. I just have to chat. So been here now 16 years at the firm. The firm has been around for 44 years. We sure enjoyed getting out in the community and doing these presentations. We're up to about 75 employees now. We service about 1,000 client families, and our assets under management somewhere around 900 million to $1 billion, depending on what's happening in this crazy stock market that we've seen year to date. So again, thank you for having us this morning. Little disclaimer there, everybody has these. Really, the reason we have to put these in is that this is a general overview about charitable contributions. Everybody has their customized and individual situations that are all unique, and I think that's what's really cool about my job, is that every one of our clients, every one of our planning opportunities is unique and customized and different. For this scenario today, obviously, this is going to be more of a general overview rather than getting into specifics. Again, if the folks online have some questions at the end that are specific to their situation, we'd love to take those. The next slide, again, just trying to satisfy your philanthropic goals and save some tax dollars along the way. We're going to get into a few strategies, again, how to mitigate taxes, save a few tax dollars while still giving and supporting your favorite charity, whether it be something local or something more on the national scene. We will get into some various methods and strategies, and anytime any of us can save some tax dollars, that's a good benefit. Charitable contributions, there may be some small business owners in the group or that watch this later, but these charitable contributions are not a deductible expense, whether you're a sole proprietor, or maybe you're an LLC, or maybe your small business is a partnership. These are all pass-through entities, we call them, and the charitable contributions eventually have to end up on the individual's tax return. More specifically, it has to end up on your Schedule A, which we may or may not know is our itemized deductions. So again, these are not business expenses. They have to end up on your personal return, on your 1040, on the Schedule A itemized deductions. Sole proprietor, LLC, partnership. A lot of folks list charitable contributions on their P&L. Again, like I said, these need to be added back and put on your Schedules A. Partnerships, oftentimes these contributions will come through and be seen on a K1. And again, they do need to get to that Schedule A. Still, as a reminder, political donations do not count. And we are not dealing, in this presentation at least, with S Corps or C Corps. That's a whole new ballgame and definitely outside of the scope of this presentation, something we may be able to discuss in the future. What could determine my best, most appropriate, correct charitable vehicle? Lots of things go into this decision. First and foremost, size of the gift. If we're giving a few dollars, or we want to give a little bit to our church or throw it in the basket of the Salvation Army around the holidays, or are we talking about several thousands of dollars? to be handled by a trust. Again, size of the gift is definitely a key in terms of what charitable vehicle makes the most sense. Types of accounts I have. Do I have retirement accounts or do I have individual accounts where maybe I've got some long-term stock holdings that have done very well, they've appreciated, and I've held them longer than a year. We'll get into some of the specifics regarding that as well. Who is the gift for? Very key. What age am I? 70 and a half is a key age. We help a lot of our clients that have reached that age doing some planning and some strategic charitable gifting in a very tax efficient way. And how simple and complex do you want to get? Do you want to just start with cash, or do you want to do something larger, something more complex? So these are all things that will determine the most charitable route we take. Cash, obviously, the simplest for sure. Recently, a few years ago, there was a large increase in the standard deduction on our individual 1040 tax return. You can see the current limits there now, almost $13,000 for a single income tax filer, almost $26,000 for a married filing joint return. And if we do contribute cash, the IRS has really been bearing down in this area. It's a bit of a red flag. So if we do donate cash, we need accurate documentation. And we may want to double up on a year. What I mean by that is, for example, if I'm planning on doing, $10,000 a year, maybe to my favorite charity, rather than doing 3 years at $10,000, maybe I bunch them or skip a couple of years. Maybe I do all 30 in 1 year. That obviously gets me above that $25,900 if I file a joint return. It allows me to itemize my deductions that year rather than doing a donation of $10,000 each year. That might not get me over that threshold, and I may still be using the standard deduction and not get the benefit of the donation on my itemized deduction. Long-term appreciated stock. This is what we see a lot of at our firm here. People that have brokerage accounts with some nice long-term winners. By long-term, I mean more than 1 year. It saves you on paying capital gains taxes. So depending on what bracket you are in, or you and your spouse are in, if you sell a winner, you could end up paying between 15 and 20% extra in terms of capital gains tax. Again, this will help if you are itemizing your deduction. You get to deduct the full fair market value on your Schedule A. So in that little chart there, let's start way on the furthest right-hand column. You can see in this example, if I was to donate $10,000 and I was in the 35% tax bracket, it would save me $3,500. But if I sold those securities out of my brokerage account and had to pay that 15% long-term gain, it would cost me $1,200. So net, it would only save me about $2,300 in terms of taxes. Moving to the left, the middle column, if I donated the $10,000 just in cash, I'm not selling any securities, I'm not selling any equities or stocks. So it saves me the $3,500, a little bit better scenario. The next column to the left on that is sort of our double dip column, where we get to save taxes twice, which doesn't happen often, but it's a nice perk. So again, we donate appreciated securities. We've have to held them for longer than 1 year. We save the $3,500 because it's a charitable gift. We save the $1,200 because we are donating the actual equity or stock right to the charity. So we get to double dip on those and save a total of $4,700 in taxes. So that's a very brief scenario with some assumptions, but it shows from a tax planning standpoint how we can be really aware and save some dollars while contributing to our favorite charity. Donor advised funds, DAFs, sometimes they're called, a little bit more complex, and now we're moving even to larger gifts, usually in the thousands of dollars. These can be handled by a broker. We've seen them done by Charles Schwab or Morgan Stanley, Vanguard. I think Fidelity does it. There's obviously a cost to doing this. The neat thing about these DAFs or donor advised funds is that the donors actually get to be involved and recommend or make suggestions on the grants. So the donors contribute there in the first step. They get the full income tax deduction based on what they contribute. Hopefully, depending on your manager, the assets grow, depending on what's going on in the stock market. And then the charities at the end of the day benefit, and that's again what this presentation is all about. Private foundations, very similar to donor advised funds. They are like a donor advised fund, but it's a private community foundation. The neat thing about this, and we've seen these work with grandparents, second generation, and then even kids and grandkids. I've seen these work very, very well for 3 generations of one family. It allows some accountability. It brings the kids in and grandkids, gets them involved in the charity and the contributions. And it's usually a charity that's held near and dear to the whole family. So very neat opportunity. And like I said, it gets the kids and grandkids involved at a younger age and shows just how much charities can benefit from some of these donations. Charitable trust, even a little bit more sophisticated. So 2 general categories of charitable trusts. They are a remainder trust and a lead trust, and they're the exact opposite. So on the left there, we'll start with the charitable remainder trust. Whatever is left, the remainder of that trust and what's in that trust goes to the charity. Before usually the passing of the donor, there is an income stream that goes to the creator. So if the creator, the donor is in retirement and they put all these assets in a trust, they get an income stream to help their cash flow on a weekly or monthly or quarterly basis. And then when they pass, the remainder goes to whatever charity is listed in the trust document itself. The charitable lead trust, exactly the opposite. So the income stream reverse actually goes to the charity. And then upon the donor passing, the remainder might go back to a child, a grandchild, a beneficiary, whatever may be listed in the trust document itself. And these can be done in terms of a fixed percentage that goes in terms of the income of 4 or 5%, or it can be a fixed dollar amount. So, $1,000 a week or whatever the case may be goes to the income. Some of the abbreviations that you've heard with this, you've heard of CRUT, Charitable Remainder Unit Trust. That's where a fixed percentage goes in terms of the income. And then you've heard of a CRAT, a charitable remainder annuity trust. That's where a specific dollar amount is used in terms of the income stream. So again, these are for these charitable trusts, larger gifts, a little bit more sophisticated in terms of the planning that goes into them. Next, wow, a little bit of alphabet soup there. Rebecca purposely made this slide look a little bit of a mess and some investment jargon there. So the next few slides, we'll try and get this all sorted out and put some meaning to these abbreviations. IRA beneficiaries. So a lot of us, with pensions becoming less and less prevalent, we're forced to save ourselves. We're forced to save for retirement through IRAs. They can be traditional IRAs, they can be Roth IRAs, depending on our current and future tax brackets, even SEP IRAs for people that run their own businesses or are involved in an S Corp. So IRA beneficiaries, very easy, simple, effective, flexible. IRA beneficiaries can be changed literally by the stroke of a pen, redoing some paperwork. In many states, probate can be very long process. It can be measured in months and years, definitely not weeks. The probate process in various states can be expensive, and it is public as well. So for a lot of reasons, beneficiary designations for retirement accounts trump the will and the probate process, and that can be a very positive situation. The Secure Act was passed somewhere around 2019, about the end of 2019. You see that for charities, the distribution rule now is usually about 5 years. For non-spouse beneficiaries now, the distribution rule is about 10 years. And what happened through that Secure Act is they eliminated what was called the stretch. And what the stretch was if grandpa passed away and left his IRA to a grandchild that was 15 years old, the grandchild could withdraw that money based on his or her life expectancy. So that life expectancy could be 70 years. So the government very, very, very slowly would get their tax dollars out over the next 70 years. They eliminated that. They said, we want our tax dollars now or within 5 or 10 years. And so for the most part, what we like to call in the industry, the stretch was eliminated by that act. Here's a little flow chart. Again, I won't get into everything, but IRA beneficiaries after the Secure Act, you can see starting on the left with the green, second from the bottom, the most prevalent one of that, the stretch is still applied. So a spouse. So if my spouse passes away, I get her IRA, I still can stretch it through my life expectancy if that happens to be longer than 10 years. The yellow in the middle is where you see non-spouses, most often kids or grandkids. That's where we see that 10-year rule. So even if it goes to a kid that's 20 years old, that's expected to live another 65 years, they still have to have that entire amount out in the 10-year period. Now, a little flexibility there and some tax planning opportunities based on what's happening in their life. That can come out right in year one. It can come out equally over 10 years. It can come out in the last week of the 10th year. So there's a lot of opportunity there based on what's happening in a person's life, especially on their 1040 and their tax return, as to what makes the most sense. More times than not, internally at Ullman's, we spread that out. We don't want people to bump a huge tax bracket or a couple tax brackets by taking out a lump sum. We would rather see that spread out. Third column there, non-beneficiary, non-designated beneficiary, that's where you see our charities. So again, this presentation is about the charities. RBD, some jargon there, required beginning date. Used to be 70.5, it's now 72. So when people get into that required beginning date and they are required to take out RMDs, how's that? Required minimum distributions from their retirement plans. It used to be 70.5, it's now 72. We have a lot of folks come to us say, hey, that sounds great on my IRA or my Roth or my SEP, that's fantastic, but what about adding some beneficiaries to my non-retirement accounts? Yes, that can be done. TOD and POD, transferable and payable on death. We can add beneficiaries simply, again, through paperwork to an investment account that you have at Schwab or Morgan Stanley or wherever that may be, or even to a bank account that one might hold at Chemung Canal. So you can add these, again, the beneficiary designations trump the will and remove the probate process from that action. So in a lot of states, like I said, that's a big positive. QCDs, qualified charitable distributions. We do a lot of this, and I think this is one of our last slides. This is very popular. Again, we use the RMD from the IRA. We use what's called the required minimum distribution from the IRA or the 401k from the prior slide. That's now 72, but they left, to confuse us a little bit more, they left the age that we can do these qualified charitable distributions at 70.5. So what happens in this is rather than me taking my distribution from my IRA, it hitting my tax return, I get taxed at maybe a 35% bracket, and then I contribute to my charity. I save maybe 15%. It's a taxable event. These qualified charitable distributions, what I can do, it's very cool. It goes right from my IRA. So if I have my IRA at Schwab, it goes right to the charity, skips over me, skips over my tax return, and allows me to keep my income on my tax return down. So what you see there is Maggie is just a fancy way of saying your income, your modified adjusted gross income. So by doing this qualified charitable distribution and skipping my tax return, I'm able to keep my income down. That may reduce my Medicare premiums for Part B. So we know that Part A premiums are free. Part B premiums you pay based on what your income is. So if you can keep your income down, help your charity by doing these, everyone wins. Also, by skipping my tax return, I'm allowed to keep my Social Security, the amount that's taxable, down. Social Security benefits are taxed between 0 and 85%, depending on the other income on your tax return. So if I have a huge required minimum distribution on my IRA on my tax return, probably 85% of my Social Security is going to be taxable. If I can skip that, give it right to the charity, keep my income down, that's going to help me. IRMA, that was another part of the confusing alphabet soup, income related monthly adjustment amount. What that means is, again, for Medicare, for our Part B premiums, that's done 2 years prior. So there's some confusion there. So for example, say someone was making a boatload of money 2 years ago, but now they've retired. They see on their tax return, well, why am I paying so much for my Medicare premiums? I'm retired. Well, for 2022, there's a lag. The IRS uses 2 years prior. So they're looking at your 2020 tax return and what your income was there to figure out what you're going to pay for Medicare Part B premiums now. So a lot on that slide, but that's something we spend a lot of time with our retired clients on, and that QCD is very popular and a great way to not only get your charitable contribution done, but really, really help your tax return. I went through that very quickly. I know there was a lot of jargon and a lot of abbreviations in that, but I sure would open it up. I don't know if there's questions or comments from anyone listening, but I would sure do my best to answer if there were any, Beth.
All right, I don't see any in the chat, but it's a small enough group. So if anybody has any questions, go ahead and unmute yourself and ask a question. All right, I guess that was very self-explanatory. The presentation was very thorough, so no questions asked. Thank you very much, Todd. We will share the link to the recording with you later on. You can visit chemungchamber.org to register for upcoming webinars or find recordings of previous webinars. For anyone interested in chamber membership, please contact the chamber at info@chemungchamber.org or call 607-734-5137. Many thanks to Todd and John G. Ullman and Associates, and to everyone for joining us today. Todd, did you have any other closing comments?
No, thank you for all your help in getting this organized. It went very well, and I just want to say thank you to you.
All right, and thank you again, and everyone have a great day.
Bye-bye.